Welcome to The Deep Dive, the show that takes a wrecking ball to financial documents and earnings calls, leaving you with nothing but the most valuable insights.
That's right. And if you need a shortcut to being well-informed about the complex world of corporate transitions, you are definitely in the right place.
Today, we are cracking open the Q3 2025 earnings call for ACI Worldwide, Inc., tickers ACIW.
Yep. The payment software giant, their tech is kind of the hidden plumbing for a huge amount of financial transactions for banks, merchants, you name it. The call was pre-market, November 6th.
And our mission today, it goes beyond just the numbers. ACIW is deep in this multi-year, and let's be honest, kind of painful transition.
It has been. They're shifting their business model away from selling these lumpy term licenses.
Right, to a much higher quality, predictable, recurring revenue model.
Yeah.
And the key to all of this is their new cloud-native platform, Connetic.
And that transition is absolutely critical because the stock has lagged severely. Over the last year, ACIW is down over 20%. It's dramatically underperforming the broader software sector.
So the market is basically pricing in a ton of execution risk.
Exactly. So the question is simple. Did Q3 finally provide the definitive proof points that management needs to convince the market that this whole pivot is actually working?
Let's start with the headline numbers. The stuff that first popped on everyone's screens because they delivered a clear beat. It definitely rewarded well, for a moment anyway.
They absolutely did. Starting with profitability, the adjusted EPS came in at $1.09.
And the consensus was what, 98 cents?
98 cents, so a significant beat. And GAAP EPS followed right along, 88 cents, which was comfortably ahead of the 80-cent estimate. So a really solid beat on the bottom line.
And on the top line, the story was just as good.
Just as clear. Total revenue was $482.4 million. That's up 7% year over year.
6% if you adjust for currency, right?
Yeah, 6% FX adjusted. But either way, it crushed the consensus of $465.3 million. I mean, they beat by over $17 million. That tells you demand is still really robust.
And critically, management didn't just sit on that. They used this strong print to raise their full-year guidance.
Which is the strongest signal of confidence you can send, really.
So we saw the revenue outlook raised. The new range is $1.73 to $1.754 billion. That's up from the old guide. And they also tightened and raised the adjusted EBITDA outlook.
Right, to between $495 and $510 million. So in short, like you said, a beat and a raise across the board.
But the real deep dive begins now. We have to look past those headlines and analyze the quality of that revenue.
Exactly, because that is the entire premise of the ACIW turnaround story.
Okay, let's unpack this core strategic shift. The problem they're solving is this term license variability. So for our listeners, what's the real difference between that old model and the new recurring one? And, how healthy is this shift right now?
Think of it this way. The old term license model is like buying a really expensive piece of software outright. You pay a huge lumpy amount upfront, and that revenue gets recognized immediately.
Which leads to those wild swings quarter to quarter.
Huge variability. The new recurring model, like SaaS, is like paying a steady monthly fee. It's smaller at first, but it's high margin, it's predictable, and it just keeps coming in for years.
And on that crucial metric, how do they do?
It was a huge win for Q3. Recurring revenue grew 10% year over year. It hit $298.3 million.
And as a piece of the pie.
Structurally, it's now the majority, 62% of their total Q3 revenue. That double-digit recurring growth is exactly the kind of stability the market has been demanding.
And if we zoom out to the year-to-date performance, the picture looks even better.
It does. Total revenue and adjusted EBITDA are both up a really consistent 12% year over year. That stability shows you that their strategy of cutting down on those big, lumpy license deals is actually working.
Okay, so let's get into where this growth is actually coming from, because the two main segments tell pretty different stories.
They really do.
Diving into the segment dynamics, the biller segment was the real engine this quarter. It grew 10% in Q3.
Right.
Who are they serving there? And what's driving that kind of demand?
So the biller segment is all about high volume, highly regulated industries. Think big utility companies, government agencies, places that need really specialized electronic bill payment processing.
Got it.
And management noted a powerful demand surge in those areas. The reason? As these sectors get more and more complex, they have to outsource to specialists like ACIW to handle the volume and the compliance.
Okay, so that makes sense. But in contrast, the payment software segment, the one serving banks and big acquirers, grew a much more modest 4% in Q3.
4% looks modest, yeah, but we have to remember the context. Year to date, that segment's growth is still really strong at 12%.
And this is the segment with all the sexy stuff, right? Real-time payments, fraud prevention.
Exactly. It includes their crucial real-time payment suite, which is riding a massive global growth wave. So yeah, the slower Q3 needs a look, but the overall health is still there. Plus, this is where the new Connetic SaaS platform is going to generate its highest value revenue.
And here's where we hit the really critical point. The thing that I think explains the market's continued skepticism. It's the nuance between revenue growth and profitability. While total revenue grew 7%, adjusted EBITDA, it only grew 2%.
And that raises a profoundly important question about margin leverage. It's the dilemma ACIW is facing right now. The growth they're generating, I mean, it's expensive.
Why is it so expensive?
It just signals continued really heavy investment in their platforms, specifically in developing and deploying that cloud-native Connetic platform.
Okay, break that down for me.
Think of it like this. A construction company is building a massive high-speed toll road. They're still getting revenue from their old, slow roads, right? But they have to pour a ton of concrete and steel into the new highway. That's the Connetic development before they can start collecting those higher automated tolls.
Ah, so that heavy upfront investment is squeezing the margins in the short term.
Exactly. So the market sees that 7% revenue growth and expects higher profits right now. But management is consciously sacrificing today's margin for the promise of much higher predictable SaaS margins tomorrow. It explains that show-me attitude from the market.
So investors who bought on the news and then saw it fade, they're just laser focused on that 2% EBITDA growth.
They are. They need proof that the construction is going to pay off.
But despite that near-term margin squeeze, the cash story is still solid.
It's the bedrock. Q3 operating cash flow was $73 million, which is way up from $54 million a year ago. And the balance sheet is still conservative. Net leverage is manageable at about 1.3 times adjusted EBITDA.
And that financial solidity is really the foundation for their most aggressive confidence signal yet.
This is where we get into the strategic narrative, and this is where it gets really interesting. Management doubled down on their commitment to returning capital. They already repurchased, 3.1 million shares for $150 million this year?
But the real statement, the one that speaks louder than any guidance raise, was the board dramatically expanding the share repurchase authorization.
To a massive total of $500 million.
$500 million. Given their conservative leverage, that is a profound signal that management believes their stock is deeply undervalued. It's like they're literally backstopping the equity.
And beyond the financial moves, the core strategic driver is, of course, ACI Connetic. And for the first time, they signed an inaugural Connetic customer.
Solaris, the German fintech and banking partner. Why is this one signing so important?
Because it validates the technology. Connetic is their big bet on cloud-native payments architecture. For a bank, that's a game changer. It means systems are elastic, they're scalable, and you can get feature upgrades instantly instead of waiting years for some costly IT project.
And Solaris, being a digital bank, is the perfect poster child for that.
The ideal partner. They're all about agility and speed. The CEO even stressed they were highly selective. They were looking for a partner who could really show off what the platform can do.
Right. But the catch with Connetic is the revenue recognition lag.
That's the thing. That revenue only kicks in when transactions start to flow, which means we're building a pipeline now for money that won't really hit the income statement until late 2026.
So to speed that up, they made some smart little bolt-on acquisitions. They picked up a European fintech payment components.
Precisely.
This was a small deal, but you're saying it was strategically really important. What does payment components actually do?
It's purely a technical buy. They specialize in world-class messaging translation and orchestration. Think of it like the Rosetta Stone for payments.
All right.
In global payments, different banks speak different tech languages. SWIFT, ISO 2022, you name it. This tech makes Connetic a universal translator. It's crucial for cross-border payments, and it directly helps ACI's goal of building an AI-first platform. It just simplifies integration, which is the biggest bottleneck.
And then they added the BitPay partnership, which brings crypto and stablecoins into the mix, so they're kind of future-proofing the platform.
It all ties together. They're systematically knocking down technical barriers with payment components and expanding what they can do with BitPay to make Connetic the go-to platform for modernization. And the pipeline reflects that. Net new annual recurring revenue bookings. They accelerated 50% year to date.
50%, that's a huge number. And the total 60-month backlog is now over $7 billion.
Yeah. I mean, that indicates substantial pipeline visibility stretching well into 2026. The sales engine is clearly firing on all cylinders.
And yet, despite all of this, the beat, the raise, the massive buyback, the first Connetic customer, 50% ARR acceleration, the market's reaction was, I'd say, measured.
Very measured. The stock jumped 5% immediately, but it gave back a good chunk of those gains the very next day.
That hesitation is the core of the investor dilemma, isn't it? Why is the market still discounting ACIW, even when management is screaming confidence with a $500 million buyback?
The market is fundamentally waiting for that margin equation to flip. Management is positioning the company for, mid-teens EPS growth once Connetic is fully scaled. But right now, investors are just staring at that 2% Q3 EBITDA growth.
They need to see tangible evidence.
Tangible evidence that the heavy spending is done and the high margin revenue is finally flowing in.
So the catalyst map for 2026 is critical. What are the key milestones you're watching for?
First, more Connetic customer signings. And not just signings, but go-live milestones where we see actual revenue start to materialize. Second, we need to see monetization from BitPay and a successful integration of payment components.
Prove that the bolt-ons are working.
Exactly. And third, sustained multi-quarter acceleration in those net new ARR bookings. Keep that 50% momentum going.
Management also confirmed that pricing is an important lever, which tells me they think they can charge more as they move customers on to the higher value Connetic platform.
They absolutely see significant embedded pricing power once that platform shift is complete. The whole narrative arc has shifted from, turnaround and repair to proving compounding growth.
Which brings us to our mandatory segment. This is where we pitch a high conviction, potentially outrageous trade idea based on what we've just discussed. And we have to remind you, this is strictly for entertainment and education. It is absolutely not investment advice.
Duly noted.
So let's review the setup one last time. Despite beating every number and raising guidance, ACIW is still discounted. Execution skepticism is baked into the price.
Right.
Yet management just signaled profound confidence with a $500 million buyback, and their balance sheet is solid. They're explicitly telling the market, we believe our stock is cheap.
So given that deep discount and that powerful capital return signal, what's the outrageous but plausible trade here?
We're calling this the capital allocation arbitrage play. The action is to simultaneously buy shares and purchase long-dated, slightly out-of-the-money call options, let's say 18 to 24-month duration.
Okay, explain the arbitrage thesis. Why the dual approach? Buying both shares and options.
The aggressive $500 million buyback provides a significant floor for the stock price. Management is explicitly backstopping the valuation, which minimizes your downside risk. If the stock drops, they're authorized to step in and buy up to $500 million worth of shares.
So they're essentially creating a floor based on their own free cash flow profile. The buyback hedges the downside from that show-me story, okay, and the long-dated calls.
The calls are your pure leverage on the strategic upside. They are a low-cost, long-dated way to maximize your exposure to the Connetic catalyst. If that pipeline, starting with Solaris, successfully turns into high-margin SaaS revenue in 2026,
the market will be forced to re-rate the stock closer to its software peers.
Exactly. Peer multiples are significantly higher. So this play uses the financial engineering of the buyback to protect you while maximizing your exposure to the growth story. It's a high-conviction bet on management's belief in their own future.
A very calculated way to play their conviction signal without fully exposing yourself to the timing risks of a multi-year transition. That's an interesting thesis.
So to recap, ACIW delivered a clear beat and raise, showed 10% recurring revenue growth, landed that crucial first Connetic customer, and authorized a massive $500 million buyback. The transition is clearly accelerating.
But the core question remains. The narrative has shifted from fixing the mix to proving compounding growth. And the market's reluctance, that quick price fade, it suggests a lot of investors are still on the sidelines, waiting for the actual high-margin SaaS revenue to show up.
The final provocative thought for you, the long-term investor, is this. With the stock still trading at a discount, Does the combination of accelerating ARR bookings and a massive capital return plan offer a temporary window to get in before Connetic's revenue fully hits in 2026 and forces a permanent re-rating of the stock?
Something to ponder as that $7 billion backlog begins its journey onto the income statement. Thanks for joining us for this deep dive.
We'll catch you on the next one.